In this video, we're going to talk about accounts receivable. So accounts receivable is essentially money that you are owed, money you are due for goods or services, goods/services you provided on credit. So if you run a little candy store, you probably don't think a lot about accounts receivable because people come in and they pay cash for the candy they buy. But what if you're going for something larger? Let's say, for example, that you come up with a new toy for Christmas season, a new toy, and you sell it to Target. So Target stores, they love your toy. They decide that they're going to buy, you sell them 10,000 units. You sell 10,000 units of this toy to Target, and you sell it for $2 each. Now what's going to happen here? Well, Target is not going to have an employee run over to your house and hand you $20,000, right? What's going to happen is you're going to ship the units. You're going to ship these units to Target. And then you're going to send a bill to Target. You're going to bill them for $20,000. That's just the 10,000 times the $2. That's $20,000. You're going to bill Target for $20,000, and then Target will pay you in 30 days and 60 days, whatever their policy is, and depending on the arrangement you have worked out. But they're not just going to hand you cash the day they buy the toys. So that's where accounts receivable comes in. Accounts receivable is basically you are saying to Target, okay, I'll put it on your tab. I'll give you credit, I'll extend you credit, and you just pay me in 30 days. And so when we think about the journal entry that's going to happen here, so when you have the sale, when you actually sell this to Target, because you're not receiving cash, we're going to debit accounts receivable. Accounts receivable is an asset account, so it's going to increase with a debit. And again, we've got $20,000, which is just 10,000 units at $2 each. So we're going to debit accounts receivable, and we're going to credit sales. So we had a sale here. We sold some of our inventory. So sales go up, accounts receivable go up. Now, when we actually collect the money, so we sent out the bill, and at some point, Target's going to send us a check, and then we'll cash that check and so forth. So when we collect, now we're going to have another journal entry. Now this journal entry, we're going to be, so let's just assume here that Target pays us in full. We're going to have to now reduce the account receivable account, right? So we're going to have a credit to accounts receivable. Target paid us in full, so we'll credit account receivable $20,000 to zero it out, right? Because it's no longer receivable, that $20,000, we have received it. And what did we receive? Well, we received cash. So we're going to debit cash for $20,000. So this is just saying, really our assets under this transaction don't change. Our assets stay the same because we're reducing our accounts receivable, which is an asset. We're saying, okay, this is no longer receivable. We've received it. But now we're decreasing this one asset class, but we're increasing another asset class, which is cash. We've received the $20,000, it's no longer receivable. So a lot of times you'll hear a certain firm, you might look on Craigslist or something and you see, oh, it's an accounts receivable coordinator, and you're wondering what that is. Well, that might be somebody who is very likely working with these types of transactions where they're verifying that these people are in fact eventually paying. They're making sure that the amounts that are receivable are actually collected and kind of accounting for that fact. They're working in this space here with the accounts